Welcome to the Deep Dive. Today, we're taking a really fascinating trip back to 1997.
1997. The bull market was, well, it was definitely running hot then.
It absolutely was. But,
Yeah.
not everyone was just blindly celebrating. We've actually got our hands on some key excerpts from a specific annual report to shareholders from that year.
And this thing, it reads almost like a contrarian investor's playbook, doesn't it? Full of pretty stern warnings and meticulous strategy.
Exactly. So our mission today is to really dig into how this company managed to achieve, frankly, incredible internal financial success. We're talking compounding returns over 20% on equity.
Which is huge.
Huge. While at the same time, they're issuing this red alert, basically warning that the global market was, getting into bubble territory.
That's the core paradox, isn't it? And it grabs you right away.
It does. I mean, look at their 1997 numbers, objectively speaking. Stellar. Net income jumped 54%, $232.5 million.
Amazing.
And book value per share up an incredible 44% to $125. Just phenomenal internal growth.
And here's the kicker.
Right. The share price only went up 10%. It massively underperformed the S&P 500, which is up, 31% that year?
Yeah. So the market was just profoundly unimpressed. Or maybe skeptical.
Skeptical is a good word. That gap, between this amazing internal performance and a stock price that just went sideways, that's really the core insight here, I think.
Definitely. It seems the market just refused to believe that generating over 20% return on equity was actually sustainable.
And the company's response?
Pretty much, we don't really care what the short-term price does. They were just laser-focused on compounding intrinsic value over the long haul.
And that rigid philosophy, it seems it drove every single decision they made.
Let's look at those numbers again, the ones the market apparently ignored. This wasn't just a good year. It was like a record year for them internally.
Yeah, beyond the 54% jump in net income, you had earnings per share up 41% to $21.59.
And the realized capital gains were a record too, right?
A record $207 million.
Yep.
Which obviously contributed massively to their pre-tax income. They were firing on all cylinders internally.
And they didn't just sit on that cash. They immediately put that financial strength to work. Strategic moves.
Primarily strengthening their global reinsurance business, wasn't it? The Odyssey Re Group.
Exactly. The big move there was buying Sphere Drake.
Which was listed in London and New York, I believe.
That's right. A London NYSE reinsurer.
And this wasn't just about getting bigger, was it? There was a clear strategy.
Oh, absolutely. The total price tag was about US $217 million, but the goal was critical. Achieving global scale and diversification.
Right. So Sphere Drake instantly gave them that footprint in London and Bermuda. Key markets.
Key markets, yeah. And it helped consolidate Odyssey Re Group into, well, one of the world's top reinsurance players. We're talking over $1 billion in capital.
Wow. But what's really interesting, maybe even unique, is how they structured the deal to protect themselves.
Ah, yes, the financial architecture. Because, buying an insurer, especially back then, carries this huge potential risk from the past. Long-tail liabilities.
Like asbestos claims or environmental issues popping up decades later.
Exactly those kinds of things. So how do you buy a company like that in 1997 without taking on massive unknown risks from its history?
Okay, so how do they mitigate it?
Well, they engineered this highly unusual downside protection mechanism. It involved a 10-year, 8% contingent note.
Sometimes called a contingent value or CVR.
Precisely. Worth $4.50 per share. Think of it like a decade-long insurance policy baked into the deal.
Okay.
This note basically provided an initial $171 million indemnification. It covered them against nasty surprises in Sphere Drake's reserves or, bad debts turning up from their existing business.
So wait, the seller was essentially guaranteeing the quality of their own books up to a point for 10 years. That's pretty intense.
It's incredibly intense. Shows a massive amount of due diligence and risk transfer built right into the acquisition price. It let them be bold, create this big Odyssey Re Group holding company.
Coordinating Odyssey Re, CTR, Sphere Drake.
Right, exceeding that $1 billion in capital, but doing it while rigorously, and I mean rigorously, limiting their exposure to hidden problems.
That focus on absolute protection, it seems like it flows directly into their core philosophy.
It does. It's all about value, returns, and maybe above all, risk management.
And the cornerstone seems to be that 20% objective.
Yes, the 20% number. It's a foundational. They state quite clearly that any capital they deploy, whether buying a company or just growing internally, has to aim for a 20% or better return on the additional shareholder equity it creates.
And it's not just aspirational, is it? It sounds like a hard threshold.
Completely non-negotiable, a threshold for entry, and they point to their track record.
Like Lombard, which returned 54% after tax on the purchase price.
Exactly. And the original Odyssey was at 32%. CTR was lower, around 14%, but they expected it to get to 20%.
So they understand that just growing assets, getting bigger for bigger's sake, it's kind of useless if the return on those assets doesn't crush long-term interest rates.
That's precisely where intrinsic value comes in. And they define it quite simply for the reader, for you listening.
How do they put it?
Intrinsic value is based on future earnings or the cash flows that will eventually be available for distribution to shareholders.
Okay.
And here's the critical link. If a company consistently earns way more than the cost of capital, say, their target of 20% plus on equity,
Then its intrinsic value has to grow beyond its book value.
it will exceed book value. And over time, the stock price must reflect that reality. That's the core belief.
Like an assertion that, time and discipline are on their side. Value will out.
And backing up that discipline is this intense financial conservatism. You really see it on their balance sheet.
Yeah, the cash position just in the holding company doubled to $207 million.
And they calculated this survival ratio. Get this enough cash at the holding company level to cover all their admin and interest costs for 5 to 6 years.
Even if the operating companies paid zero dividends up to the parent.
Zero dividends. That is an almost unheard of safety margin in corporate finance. It's extreme.
They weren't just prepping for a rainy day. They were prepping for like a 5-year ice age.
Pretty much. And speaking of cushions, they quantify their rainy day reserves at $221 million. And part of that comes from something called negative goodwill.
Negative goodwill. That's a specific accounting term. What does that signify here for you listening? It sounds like a good thing, but it's treated as a reserve.
It's the ultimate sign of buying something really cheap, basically. It happens when you acquire assets or a company for significantly less than their fair book value. You got a massive discount.
Okay.
But instead of just booking that gain immediately, which would flatter earnings, they recognized it as a liability, a reserve on the balance sheet. They essentially bought assets cheap and then put the savings aside, untouched, just in case things turned out worse than expected down the line.
That's incredible financial humility, isn't it? Buy cheap, then prepare for the worst anyway.
Exactly. And that extreme conservatism, it naturally colored how they viewed the roaring bull market.
Which brings us neatly to how they handled market turbulence and communicated, or perhaps didn't communicate, with shareholders.
They were brutally honest about their own stock's volatility. They openly reminded shareholders about the 60% drop they saw back in 1990.
Right. And their message was pretty blunt.
Unequivocal, really. Short-term price swings? Meaningless. As long as they hit that 20% long-term objective for intrinsic value growth.
They even used that great analogy, the 100-to-1 split idea.
Yeah, saying if their stock, trading around $320 then, was split 100-to-1 down to $3.20.
And a $1.75 fluctuation wouldn't even raise an eyebrow, even though the percentage move is identical.
Exactly. The volatility feels huge in dollar terms, but percentage-wise, it's just noise if the underlying value is compounding nicely. It's psychological.
And this mindset directly led to their, well, let's call it controversial shareholder communication policy.
The infamous no-call policy.
Okay, wait. The report mentions the head office only had 13 people. 13.
Tiny.
And they flat out refused to take individual investor calls about major world events impacting insurance, like the Mexican earthquake, El Nino, the Asian crisis. Isn't that just corporate arrogance? How do you even defend that?
Well, their defense was purely about pragmatism, resources, and focus.
Meaning,
with such a tiny team, their time was incredibly limited. It had to be spent allocating capital, managing the businesses, underwriting risk, not hand-holding investors worried about daily news headlines.
So the argument was all the important legally required stuff is in the report's annual, quarterly press releases. If it's material, you'll read it there.
That's the gist. If you need constant reassurance or want to chat about the stock price, this probably isn't the investment for you. Go read the filings.
It's a defiant stance, isn't it? Prioritizing long-term value creation way above managing short-term shareholder sentiment.
Completely. And tied into that is the mention of management control. The chairman held all the multiple voting shares, which, while good for long-term stability, also meant shareholders couldn't really force a sale for a quick premium.
Okay, before we hit the big market warning, let's quickly touch on their actual insurance operations performance in 97. The total insurance combined ratio was 103.8%.
Right, which was actually slightly better than 1996.
And 103.8% means, remind us, especially compared to the ideal 100%.
Sure, so a 100% combined ratio means you break even on the insurance underwriting itself. Premiums coming in exactly match the claims going out plus expenses. Below 100 is an underwriting profit.
And above 100.
Above 100, like 103.8, means they paid out slightly more in claims and expenses than they collected in premiums. A small underwriting loss.
Was that a concern? Or expected?
Likely expected, maybe even deliberate. In what they probably saw as a soft market, disciplined underwriters sometimes accept a small underwriting loss to avoid chasing risky business or under-reserving. They prioritize balance sheet strength over marginal underwriting profit.
Especially for long-tail lines.
Yeah.
Got it. Commonwealth and Federated still did exceptionally well, though, right? Sub-100 ratios.
Oh, yeah. Commonwealth at 88.8% and Federated at 95.9% were still printing money on underwriting. Ranger improved dramatically, too, getting closer to that 100% target.
Okay, so the core insurance business was solid, conservatively run. That sets the stage perfectly for the big one, the investment red alert.
This is where it gets really interesting. Despite their own record realized capital gains in 1997, management formally declared a red alert status for North American stock markets.
Talk about contrarian, cashing winners, but warning everyone else the party's ending. Why? What were the reasons?
They laid out three main drivers for their caution. First, the real possibility of deflation spreading from Asia, given the massive currency devaluations happening there.
Okay, contagion risk.
Second, just a profound lack of what they considered genuine investment values left in the U.S. market. Things looked expensive.
And third?
Third was something they called mindless long-term investing in mutual funds. They were worried about naive money piling in.
Wow. And they back this up with that specific GE anecdote, which is just stunning when you read it.
It really paints a picture, doesn't it? They pointed out that General Electric's market cap in 1997, $241 billion, was more than the combined stock market value of 5 entire Asian countries.
Malaysia, Indonesia, Thailand, the Philippines, and South Korea. All of them combined, worth less than GE.
And GE itself was trading at 27.5 times earnings, which they noted was getting very close to the peak valuation levels seen way back in 1972.
Right before the S&P 500 basically got cut in half.
Exactly. So for them, it was a flashing red light for irrational exuberance. The value disconnect was just too stark to ignore.
But they had a second, maybe even more structural warning, didn't they, about the mutual fund industry itself?
Yes, and this was incredibly prescient. They highlighted the huge shift of assets. Fidelity, the biggest mutual fund company then, had $550 billion under management. Compare that to Citibank, a huge bank with $311 billion in assets.
So funds held vastly more assets than major banks.
Mm-hmm.
What was the specific risk they saw there?
Systemic stability, or the lack thereof. Banks, have the Federal Reserve as a backstop. They have strict regulations, liquidity requirements.
The mutual funds.
Mutual funds didn't, and largely still don't, have that same safety net. The report warned, quite bluntly, that mutual funds were potentially one phone call away from having a run on them with no preventative measures in place.
Meaning, if investors panicked and started demanding their money back en masse,
the funds would be forced sellers. They'd have to dump stocks into a falling market to meet redemptions, which could cause a virulent decline, potentially cascading through the whole economy.
that's a chilling warning for 1997. And they didn't just talk about it, they acted. The portfolio shift was pretty dramatic.
Oh, absolutely dramatic. They walked the talk. They slashed their exposure to U.S. and Canadian stocks.
How much?
Pushed their total common stock holdings down to just 10% of their entire $5.8 billion investment portfolio, which the report notes was the lowest level in the company's history up to that point.
10% in stocks during a roaring bull market. That takes nerve.
Yeah.
So if they were selling high in North America, where did the money go? Where were they buying?
Exactly where you'd expect a contrarian to look, Japan and the Far East.
And why there specifically?
Because those markets had already crashed. They were down 50% or more. Currencies had been hammered. That's where they saw value emerging from the panic, buying when others were desperately selling.
Classic. And their other big defensive move, you mentioned bonds earlier.
Yes, they built up a massive position, $2.2 billion in high-quality put bonds.
Okay, explain put bonds again. How do they work, and why were they perfect for this cautious outlook?
They're actually quite clever, especially for someone worried about uncertainty. A put bond essentially has dual maturity characteristics.
Awesome.
If interest rates go up after you buy it, you have the put option to sell the bond back to the issuer at a predetermined price, usually par, much sooner than its final maturity date.
So it behaves like a short-term bond, protecting your capital from rising rates.
Exactly. But if interest rates go down,
You just hold on to it.
you hold it. And now it behaves like a regular long-term bond, benefiting from the falling rates, giving you price appreciation and locking in that higher original yield.
So it offers protection if rates rise, but upside if rates fall. That's a great risk-return profile for uncertain times.
It's an excellent hedge, perfect for a company that, as the report mentions, was already running monthly doomsday tests.
Doomsday tests. What were they stress testing?
They simulated violent market fluctuations, big drops in stocks, spikes in interest rates to see how it would impact a regulatory capital. They wanted to know they could survive a severe sudden storm.
And they concluded back in '97 that such a test might be needed sometime soon.
They did. Talk about preparing for rain.
So when you kind of zoom out and look at the whole picture from this 1997 report, the formula for their long-term success, that incredible 41% annual compounding of book value over the previous 12 years, it becomes pretty clear, doesn't it?
It really does. You've got this strong, diversified, very conservatively run insurance base providing the foundation.
Then you have a proven, maybe even genius investment team managing this huge $5.8 billion portfolio with a deeply contrarian and disciplined approach.
Add in that lean, focused head office, the track record of financial soundness bordering on paranoia.
And underpinning it all is this unwavering commitment to long-term intrinsic value and integrity, even when the market completely ignores you.
That commitment really is the ultimate lesson here, I think. It's patience, discipline, and ignoring the noise.
Absolutely. Which leaves us with maybe one final provocative thought for you, the listener, to mull over.
Okay.
Given everything we've discussed, that explicit red alert in 1997, the specific warnings about mutual fund fragility, the GE valuation peak, how soon after 1997 do you think this company's doomsday test scenario was actually put to a real-world test?